So this was invented in the last 30 years or so. And what I want to emphasize is that there was a liquidity backstop to this. It was a kind of immature liquidity backstop. It wasn't a government liquidity backstop. It was a private liquidity backstop. So I'm showing the shadow bank as having a liquidity put here. I'm showing the money market mutual fund also having a liquidity put, and showing those as assets of these shadow banking entities and as liabilities of the traditional banking system. Okay. So what do I mean concretely here by liquidity put? I mean that Citibank, let's say, call it a traditional bank. It's many things. It's a shadow bank also. But so Citibank said, you know, not just said, it wrote in contracts, okay, when it created these offshore entities, said, well, if you ever have trouble rolling over your repurchase agreements, okay, they come due every 3 months, let's say, and if you ever have a problem renewing them, maybe because people are worried about the value of this asset here, that's the collateral for it, or maybe just there's disruption in the money market in general. It's not anything to do with the quality of the collateral, but for whatever reason, if you can't roll it over, I'll roll it over. Okay, that's what it means to have a liquidity put. Citibank says, I stand behind you. If you cannot issue RP and borrow from a money market mutual fund, I will lend you whatever you need to roll that over. Okay, so that was and some of these were official and written down in contracts. Some of them were just reputational, that the banks that had set these up, once they ran into trouble, they felt obliged to help them. This is true of the money market mutual funds too. You know, that typically they had some larger banking entity that was backstopping them, and it was a private backstop. And the one that failed, the Reserve Primary Fund, failed really because it didn't have a larger entity that it was connected to. The other ones, all the money market mutual funds had runs on them, but the only one that failed was the Reserve Primary Fund because the others were backstopped by their parents in some way or other. So there's an immature liquidity backstop. It's a private liquidity backstop. And it works only if the parent, if the private backstop is itself healthy enough to absorb this. You know, if the crisis is large enough, okay, then it becomes a crisis for the traditional bank too. And then what happens? The government backstops kick in, right? Because the government backstops are backstops for the traditional banks. The traditional banks were backstops for the non-traditional banks. And so indirectly, the government was on the hook. And it wasn't even clear that the government realized that it was on the hook, that it realized there were all of these side agreements that were going on. So, so that's one. There are these liquidity backstops. There have to be. In that sense, we understand that it's banking. There has to be some sort of lender of last resort here, but it was a private lender of last resort. There's a solvency backstop too that was also immature, and in fact, in a way, this was even more immature. So let me explain this slide. So I'm now showing, these two are familiar. Here you see the residential mortgage-backed security broken down into tranches, and the shadow bank having the high tranche with money market funding. I had just RP before. I'm showing now, though, that the shadow bank is getting a sort of capital put by using CDS, by using credit default swaps that are referencing this high tranche here. Okay, so we know what credit default swaps are now from last time, and what that means is that if the high tranche falls in value, this credit insurance rises in value. So that's the idea here. So it's meant to ensure the solvency of the shadow bank in that sense. Okay, I'm showing that high. So this is CDS. This high CDS means CDS on the high tranche. Okay, and I'm showing that as a contingent asset of the shadow bank and a contingent liability of AIG, let's say, okay, insurance company here. These other tranches have to be placed somewhere in order to make this go, and this is sort of not so far from reality, which is that the mid tranche, the somewhat more risky tranche, was held by a pension fund or an insurance company as an asset here, and maybe they used CDS on that tranche as a way of controlling their risk in some way or other. I'm showing them as having capital and defined benefit plan, DB, for the pension fund, or an annuity, a liability for an insurance company. And the low tranche I'm showing being held by a credit hedge fund of some kind that's taking big risk, and it's controlling its risk by buying some CDS on that low tranche. I'm showing an investment bank, think Lehman Brothers or Bear Stearns or something like that, making a market in these CDSs. So remember how last time I was talking about they have CDS on both sides, high tranche CDS here, mid and low tranche here, but these things are going to move together. Okay, maybe not one for one, in fact, definitely not one for one, but they're referencing the underlying assets, underlying mortgages are the same here. So you're on both sides of this market, making a market. So they're a dealer, okay, but the ultimate support of this system comes from AIG, which is the one sort of writing these naked CDS here. But on the highest tranche. So they could say to themselves, well, we're not really taking very much risk. In fact, maybe it's just regulatory arbitrage anyway. You know, these are AAA to begin with, and it's just some regulator required us to do that, and so we'll just do that and pick up those nickels. Well, we know what happened, okay? Lehman went away, okay, AIG went away, and the prices went into free fall. And so this is the kind of Rube Goldberg, this complex machine that we had. All these different balance sheets and everything, and they interacted in ways that nobody kind of even understood how they were all connected until it all collapsed. So we're not going to do this again. We're not going to build this again. But we may build something else. Just to remind you, you've seen this one before. This is what happened. So these immature liquidity backstops and immature solvency backstops proved their immaturity by basically collapsing under stress. And what happened, the liquidity backstop meant that everything drops onto the balance sheet of the Fed. And so there you have Bear Stearns collapsing here, you have Lehman and AIG collapsing here, you have the Fed tripling its balance sheet more or less overnight after Lehman and AIG. So that's sort of stage one in understanding shadow banking.